All right, well, let's talk about another big story here. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, or PCE, ticking higher in July, up 0.2% for the month and up 3.3% from a year ago as consumers spend big this summer. The core inflation number, which excludes food and energy, also rose a 4.2% on a year-over-year basis. This coming after the Fed reiterated its target of 2% inflation in Jackson Hole. Our next guest here to break it all down, we want to bring in Lakshman Acuthan, Economic and Cycle Research Institute co-founder. Lakshman, great to have you here. So,
thank you.
I think everyone's trying to figure out, how is the Fed looking at this and what does this mean for future policy decisions? The fact that inflation is still so sticky, is it going to be maybe what moves the needle for the Fed to hike again?
Well, the hiking again, there's the bets have been all over the place, but I think the higher for longer piece is more reliable, and this data kind of supports that. What they were saying in Jackson Hole was kind of reiterating that to a degree. But here, if you have on the surface higher expenditures, higher consumption, and some sticky prices, that's a recipe for the Fed to say, we can't say mission accomplished just yet.
So in not saying mission accomplished just yet, does that mean, because if we're looking at the probabilities for September, you kind of take any decision out of the table or out of the tape there, but then you look towards November like many investors have been. And is there any difference, massive difference in data point that we should expect between now and then that would lead them to make a decision on an increase in November?
Well, I think, look, the hope has been springing eternal that, hey, they're done. They're going to cut.
Yeah.
And then they say, no, not yet. We're not there with you. Yeah. And that's the tug of war that has been going on between the markets and the Fed for a long time. It was back in May of this year, just the beginning of the summer, and the markets were pricing in a couple hundred basis points of cuts by June of next year. Now, I think it's around 25. So there's been this back and forth, and the market is saying, are we there yet? And the Fed's saying, yeah, not yet. And here we are with PCE core deflator today, sitting at 4.2. That's too hot. And if you look at that number, which is their preferred measure, and you listen to what they were saying, what the chairman was saying in Jackson Hole, which is, hey, I really, 2% is my target. Those are two different numbers. And so higher for longer. The betting on September and November will oscillate back and forth, but I think we're higher for longer.
Do you think that 2% target still makes sense in this environment?
Yeah, in the sense that the Fed needs, they're nothing if they don't have this credibility. They need some credibility, right? And they messed up, as I won't go into it, but they messed up, and they've got to re-earn that inflation fighting credibility. Not just the Fed, other central banks, the ECB is doing it too, and so I expect that we'll see higher for longer. What was a little alarming, actually, in today's data was a pretty sharp drop in the savings rate, where, yes, people are spending. Yeah, every leisure and travel and all of that stuff, it's been the YOLO summer. All of us know that. Taylor Swift, all these other things, right? And it's come at a cost. You've had to dip into your savings quite a bit to maintain this. Now, what happens in the fall? We'll have some student loan payments that'll start to restart, and we'll have other you're kind of back to reality in a way. And let's see what happens there. Maybe the savings rate can go down further. Maybe people will be able to borrow more money, but that credit crunch is still propagating through the economy, and we'll have to see how that lands.